Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to a couple of topics: wealth building, commodities, and financial topics. So let's dive in there. Let's take a look and see what people are sharing. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, where I dive deeper into these topics. I do lots of technical analysis trainings on the question and answer session videos. There's trainings located on the website, and we dive deeper into potential investment opportunities out there, both on a technical level and sometimes on the fundamental level of what the company has in their presentations. So, diving in here, we've got Holger, good old Holger. Number of new Bitcoin wallets drops to the lowest level since 2018. Only an average of 275,000 addresses were added to Bitcoin network each day in the past week, compared to 625,000 6 months ago. Bitcoin, nevertheless, rises by 2% in the everything rally to 67.5 thousand. So this is the number of new addresses on the Bitcoin network. And to me, I don't want to jump into this. It looks like this was the growth phase from 2010 all the way to 2018. We've got kind of this Batman looking pattern here, potentially. And then we've broken out potentially of this neckline to the downside where maybe we don't see the adoption rates go up as much. Maybe this is a dying thing here. Maybe we actually start to see addresses grow a lot slower. We'll see. That's probably my guess of what this looks like, and technical analysis can be applied to things like this. But that doesn't look good for all of the growth and all of the adoption that people were, I think, attributing, because a lot of people do calculations of the market cap of Bitcoin, and they're like, well, if this percent of people were to adopt it, and I know that we're at a very low percentage right now, but I don't know, this data doesn't look all that great. Coming down to Jason, it says selling CCJ at $21 because of Westinghouse. And now in 2024, we're buying CCJ at $54.90 because of Westinghouse. WEC is the best deal of the cycle in terms of Westinghouse. So, that's also attributed to the market psychology too. They just make up crap anyway for why people buy things. So, yeah, that's kind of the psychology of things when people kind of buy and sell. We've got Eric here. He says, looks like a rising standard of living to me. And people always show stuff like this. They say real personal consumption expenditures per household. And then they say the standards of living to a certain person. And then they show a economic or financial metric. I don't know if I would necessarily say that the standard of living is directly related to real personal consumption. I don't think that's necessarily the case. I mean, I think the standard of living of how I would maybe calculate it would be more of like happiness out of someone's life, or fulfillment, or perhaps how many hours worked for something to be attained. Just because you spend money and you see that real personal consumption, which is probably a highly doctored number, is going up, I'm going to just say that's probably not the case, guys. We know that they understate inflation. We know that they have massive hedonic adjustments going on with goods and services. I'm sure if you were to compare a washing machine today versus a washing machine in the 1970s or 60s, that the difference between those two machines is really nothing to me. If my clothes get cleaned, great, that's awesome. But when they look at this stuff, they'll say, well, a washing machine today is, 7,000% better than the one in 1960s. And I just scratched my head like, what kind of drugs are you on? Like that's all I do. It's like you've got an input of dirty clothes, and then you have to measure the actual difference of output of how much better those clothes are cleaned. And then you have to look at what is the minuscule difference between the washing and dryer of that 1960s or 70s versus today, and does it even make a measurable difference to the satisfaction of life? So my point is, the answer is no, it doesn't make a beans of difference. And number two, it probably costs a lot more. A new washing machine probably costs more in terms of the percent of purchasing power versus what a person makes versus what it did in 1960s or 70s. So I kind of disagree with data like this. And then people will say, oh, you disagree with the data. And it's like, I disagree with this whole thing here. The way it's set up, the way you're measuring it, and the way that you are correlating it to standard of living. Coming down, we've got Logan. It says John Burns, market share of U.S. home purchases by landlords with 1,000+ properties on a quarterly basis. What he's answering is a lot of these guys, they always talk about these investors coming in and buying up all the homes. So it's more interesting to see institutional investors' portion of recent years' purchases. In some markets, it can feel like they are driving the action. And his answer is, well, they're not, because they're only 0.4% of the transactions occurring in second quarter of 2023. And I don't even know if this really matters. You can see the bottom of the market was back here, and then you can see it ramped up. It kind of cycles up and down on some movements here. So I don't think it really matters all that much based off of market share of these larger landlords and the purchases. I don't see a clear direction here in terms of the real estate cycle and even these investors buying stuff. Coming down, Homebuilder super cycle in one chart. It says as gross margins trend well above normal 3 years running, a lot of debate lately on whether builder margins reset to an elevated new normal. Many seem to think we're not going back to 19 or 20% anytime soon. So this is a function of the real estate market cycle, and it looks like margins are up, not down, over the past couple of years. That is an indication that we're in a expansion phase of real estate and that there's pricing pressure for the home builders. That's why their margins are up. So scrolling on down, the Kobayashi letter says just in, the Biden administration announces it is releasing 1 million barrels of gasoline from a Northeast reserve. These reserves were established to supplement in times of natural disaster. However, the Biden administration said this is a move to lower gas prices ahead of the summer. The sale from storage sites in New Jersey and Maine will be allocated in increments of 100,000 barrels at a time. Energy Department officials said this should help create lower gas prices by July 4th. Energy inflation is still a major issue. So that's what we've got going on there. We had speculated that Biden is going to do something like this to lower gasoline prices. Either, I guess, hit these strategic reserves or hit the oil strategic reserves. He was going to do something, is what my guess was. Scrolling down, we got Suncor here. Suncor is an oil sands company up in Canada. It says SU is pushing up against a major decade-plus resistance level. Is it time for the Canadian integrated oil and gas company to finally break out? In my opinion, it is undoubtedly yes. We are going to see a breakout here, and whenever you break these horizontal lines that go back longer than a decade, that's when you see real fireworks in terms of upside moves. So I think this looks great. I think we're going to see a big breakout in SU, and this is also a indicator of what I think is coming to the overall oil and gas index, the whole kit and caboodle. The majors will break first, and then our small cap, mid cap producers, they'll rip it behind it. So it's looking good. Extremely important to understand that nothing matters but price. Absolutely nothing. Not buying the news, opinions in interviews, the why to intraday moves, or all the selling themselves narratives. You are always only buying price. And in order to get things right, you must ignore your bias and your emotions. Plus, one needs the right mindset, mental balance, personalized strategy, trading rules, daily routines, time management, technical tools, and experience. Also, market sentiment has to be at extremes at major tops, bullish, and bottoms, bearish, for the turn to happen. It means that most have to be on the wrong side for big turns to happen. Think hard about that one and what that means. Plus, on having the right mindset, when markets do a trend reversal, it is vital to also change your mindset because one cannot trade, for example, a bull with a bearish mindset. If you constantly doubt the bull, you will not be able to change the mindset. You have to believe in the bull, i.e., you have the tools to understand a shift has happened, or you end up being a victim of the wall of worry. Furthermore, I spend time on macro, but not as much as I did before. I have a master's degree in economics and I love the field, but there are simply way too many macro parameters nowadays for anybody to get a direction right consistently based on that alone. And many explanations for stock market moves you see are just made up narratives to have a story. It's complete rubbish. So we need to stay with the charts, our only real edge left today, as I see it, in his opinion. And obviously, he's showing a gold chart here that is broken out. So a lot of people, normal people, what they'll do is they'll see or a big down day in the markets in some junior stock. And then they'll say, well, why did that occur? What happened? What is there? You're wasting your time, guys. If you're playing this for the longer term, trying to find out every reason of a market movement, in my opinion, isn't really worth the efforts. Stick with the charts. That is one of the three pillars that I created. I look at ratios to tell me from an objective perspective, is something expensive or cheap? If we are at an inflection point where financial assets are going to peak and commodities are going to bottom, you can use ratios to identify what that looks like. Hey, they're cheaping compared to history and they're rotating off of the bottom. Makes sense. We can tell that something's at an extreme undervaluation or overvaluation using ratios. And then the market conditions, that's what I came up with because it seems like all of this rotates when the herd or humans are subjected to different market conditions. So that's why I put market conditions, which is basically looking at cycles and what the herd or humans are subjected to because money flows differently under those market conditions. Think of it as disinflation and inflation. We've got Michael Maloney here. He says, always great to chat with Ken. And then we got Ken here. So he says, change is coming that hasn't happened in 100 years. The US dollar has dominated all other international currencies for nearly a century. However, is that run of supremacy about to end? Mike Maloney had this guest on here. He says, the fall of the US dollar. The US dollar, once making up 60% of global currency value, is losing its grip as the world's reserve currency. Historical misuse of this monetary dominance, akin to a casino house always winning, has led to its erosion. Countries like Russia and China are now conducting most of their trades outside of the US dollar, signaling a significant shift. So he's got this picture here, this graph or chart, It says the typical big cycle behind empires rises and declines. And let's see if we can make sense of this. We have a new world order. We've got peace, prosperity, and productive debt growth coming up. We get into, at the later stages, a debt bubble and a big wealth gap. That's what occurs. And really what occurs is you get all this money printing, it's high inflation, and that inflation basically impacts those who do not own assets. It impacts them more, and those who own assets, they are more inflation protected, and then their assets go way up. So that's the big wealth gap on that side. Then you get a big debt bust and an economic downturn, which I think is still ahead of us. Exact timing, I don't know, but it's still ahead of us. They're going to do printing money in credit. You could say 2008 was the beginning of that debt bust and economic downturn. And then our responses to everything could be printing money and credit. That could be one thing. Revolutions and wars, that's probably coming. And then debt and political restructuring. Then the new world order for that to all start again. Currency facts, we've got this here. I'm not going to go over that. We've got the USD in milligrams of gold. This is the purchasing power going to basically nothing. And then we've got the BRICS expands footprint in the global south. And there's these new BRICS members, and it seems like the BRICS are kind of all lining up, trying to put something together for a potential currency. So there's that there. Got gold predictors here. Silver has broken the inside yearly candle of 2023 and is poised to go to 50 ounce. The long-term silver chart does not need any explanation as it is clear. And I'm going to give it some explanation. This is a cup and handle. The cup and handle continuation pattern. You lead up into it. You have some sort of, I call it a neckline or a line that goes on top of the cup and handle. On a yearly candlestick basis here of 30, and we want to close this year above $30, $31. We want to close above it and create a breakout candlestick on the yearly. The yearly, obviously, it's a made up time frame. You know, we make up these years, but it generally holds greater weight on quarterly and yearly breakouts when you close the year in the breakout territory. So that's what we're looking for. Jesse Day posted, Kazatomprom is going to make an announcement at some point in the next month about their 2025 production ability. And that could set off another huge chaotic move upside in uranium prices, says Leah Goring from Rosenswag. So we could see another catalyst here with 2025 production capabilities of Kazatomprom. Peter Schiff says, don't sell any of your gold or silver. It's easy to sell out of a bull market. The hard part is buying back in. He's got that right, man. I totally effed the last bull market with some of my holdings. Guys, I screwed it up. I screwed up. This was back I was a brand new investor. It was in the 2000s. I was trading in and out of the bull market. I had sold out during basically the beginning of a pullback. I sold out and then it rallied hard. And I just psychologically could not get back into the price action at a higher level than where I sold before. So I kind of was like, you know what? I'll just wait until it falls back below the price that I had sold it at so I could psychologically buy it back at a cheaper price. It didn't go back, guys. It frickin' flew. This wasn't in gold and silver. It was in natural gas. It was in an equity. There was a couple of them that it actually was. And I lost out on a lot of good amount of gains that I could have made if I had just sat tight. If I had recognized what was driving the bull market, which I didn't know because I was starting out, just investing there, and I was left on the sidelines, guys, and I lost, a good chunk of potential gains by trying to trade in and out of that bull market. But I didn't know what caused the bull, commodity bull market. I didn't know any of that stuff back then. So I think I'm much better positioned, both from a psychological standpoint and also from a real estate cycle standpoint and a technical standpoint too. I was just a new guy coming into investing. I didn't know technical analysis back then as well from a longer term perspective. I only knew the short term stuff. And then I didn't really do much looking at ratios or any of that stuff. I just didn't have a compass or a strategy on a longer term time frame. My time frame is too small. So he says, just sit tight and enjoy the ride. It's likely just getting started. Good things to come to those who wait. We've waited a long time, so what's coming should be great, says Peter Schiff. And I agree with him. That's actually really good opinion there. Tavi says, Shanghai and global freight costs are surging again. We just experienced one of the steepest 2-week changes in history. So here's another real steep change for a second wave of inflation. This is the first wave here. And you can see up here also the 2-week changes in Shanghai shipping exchanges. Really big move in terms of how much that has changed. Game of Trade says, warning, excess savings are now depleted. Savings relative to national income are contracting. The yield curve is pointing to a second half 2024 recession. This can get very ugly for the markets. How does he know that the yield curve is pointing to a second half 2024 recession? We actually have to see the yield curve uninvert, and we have not seen that yet. So that's what's dangerous about taking some of this at face value. That yield curve hasn't uninverted yet. And that is not necessarily pointing to a second half 2024 recession. I would disagree with that. The yield curve has to uninvert, and it takes some time for the uninversion to kind of work its way through. And I'm if I were to make a guess, I don't know where this yield curve is necessarily going to uninvert because it's still inverted and inverting. But we could get a slowdown, maybe 25, maybe 26, depends when that comes back off. And it's dangerous to try to make predictions because I don't know when the yield curve is going to uninvert, neither does he. So I think this is kind of a dangerous statement. Yes, savings are extremely low, but generally what occurs is that you are going to go down, 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 down until you get that recession. You want to go from a high savings level to a very low savings level, and that is money coming into the system. It's basically economic fuel. And that's what drives these. It's not, if we have high savings rates, you're generally in a recession or a slowdown. And when you spend it into existence, so to speak, that's when you get that boom. Millennial net worth is at an all-time high. Millennial net worth over time continuing to rocket higher. You can see the step change. We had a big step change from 2008, 2013, and then 2020, it just went vertical. And we've been going pretty much vertical goose is what I'd say. And this is probably why asset prices continue to go up, is because, we've got net worth going up pretty much vertical at this time. Mr. Uppy said silver juniors are just gearing up. We've got in 2016, SIL rallied 300%. And in 2024, I want 1,000% is what he wants. And this is SIL divided by silver ratio. The silver mining companies, the bigger ones, versus silver. We had a big rally in 2016, and maybe we can get another really big rally here. SILJ divided by SIL on a logarithmic scale. This is SILJ on the verge of an important breakout versus the silver miners. So the juniors versus the silver miners. Good things will follow upon that. And we're basically at the top of this trend line, which is a flag pattern. and we're trying to break out. So real close to that. We've got Grady here. The second inflationary wave is coming. This chart shows that lumber is having a back test against huge support once again, this time with increasing volatility, gathering energy. It says the push narrative is inflation's done. No, it's not by a mile, unfortunately. And here we are ready to rip again for lumber. And that will also indicate that we are still in an expansion phase of real estate, which we are, and we've got low inventory. That's why those margins are larger on new home builders. We're in that expansion phase. We haven't overbuilt, and if we had overbuilt, we would have a bunch of inventory. We would have inventory greater than 8 months of supply. Based on preliminary data, silver is traded at 36.20 per ounce on the Shanghai Gold Exchange, or a $4.71 per ounce premium, which is 15% above the LBMA benchmark. There's the Shanghai silver, and you can see the stranglehold that it has on the LBMA and or COMEX also following it. So it's working, is what I'll say. Grady again, he says this ratio chart shows how historically undervalued commodities and the companies are versus the commodities index, the CRB. This chart is setting up a hugely profitable move. This says this commodities bull is your ticket out of the rat race, but you have to be in it to win it now, not in 2 years. So the Canadian index here, so this is the smaller Canadian commodity companies, the TSX Venture, versus the commodity index, and we're going to see a big move to the upside. Hey, you know who's been looking at a lot of Canadian companies? This guy who's talking, me. I do think there's a huge opportunity here in uranium, in oil and gas, in energy service, in a lot of these precious metals mining companies. That's what's going to drive this higher, guys. We haven't even had the big move yet. It's coming. Get locked in and prepare. And then talking about big moves here. Some uranium stocks like these could double in no time. Top of this chart is like a 7x according to Scott. What he's got here is he's got that lead-in pattern. It's also that fractal that you see, and you get a bunch up right underneath if there's a horizontal line that should go across here. You get a bunch up right underneath it before a big move. So he's completely right. We could see a launch in uranium mining companies coming up at any point. I am positioned for it. I'm doing what Peter Schiff suggests, which is I'm not trading in and out of these stocks. I'm buying it. I'm holding on to my position. I'm not going to lose my position, and I'm going to ride this to the upside. Whenever you get these big bunch ups, like we did in silver, silver ripped it, and then you get another bunch up, and then you rip it again. Uranium's doing it right now. I'm also seeing signs of steel companies doing it, and seeing signs in other sectors that are also doing it outside of uranium, steel, silver. Precious metals are doing it too. So I think we're right before a very big move. I think Scott's right. Oh, yeah, I was on Capital Cosm. Go check that out. And that's where I'm going to end it, guys. That's what we've got. So give me a thumb up for the content, guys. Subscribe to the channel. Subscribe to the website if you'd like. We still have that coupon code MAYDAY, M-A-Y-D-A-Y, one word. It's still active. And again, that's all I've got. So we'll catch you later. This is Finding Value.